The covenant was sealed without fanfare. The pound sterling drew a sharp breath. Global markets achieved a momentary respite. Immediate financial chaos was merely deferred. In the ensuing quarters, the foundations did not crumble. Supply lines held. The banking system stood firm. But the true ledger entry for this survival never appeared on the front pages. It began to surface in restructured high-level contracts, in severed geopolitical alliances, and in the projection of power that never returned. The United Kingdom purchased critical time, and it paid for that time with permanent structural influence. In 2 minutes, you will understand how the conversion trap was sprung, why the British Exchequer accepted the covenant of permanent subordination, and critically, how this historical transaction defines the limits of independent geopolitical action for secondary powers even today. Here at Macro Threshold, your front line of intelligence in the global capital architecture, we do not focus on politics. We focus on the cost of solvency. We analyze the leverage points where monetary structure dictates political outcome. The conventional narrative holds that post-war Britain was a military victor whose primary challenge was rebuilding bombed cities. That is sentimentality, not finance. The reality was far more chilling. The nation was financially devastated, maintaining the facade of a world power only through the artificial manipulation of its currency's perceived strength, backed by an ocean of unsustainable debt. The victory was secured by borrowing astronomical sums not only from its primary ally, the United States, but also from its own Commonwealth members, creating the immense overhang of sterling balances. Effectively, IOUs held by nations forced to keep their export revenues tied up in London. This mechanism, designed to stabilize the empire, became the financial equivalent of a ticking clock. The pound sterling, nominally a global reserve currency, was in practical terms a liability bomb. Its stability rested on the illusion that pre-war monetary discipline, the gold standard mindset, could be restored without fundamentally adjusting the territorial and commercial realities of a diminished empire. The core mechanism requiring immediate analysis is the flow of cash and the mandatory debt rollover. When a nation incurs debt on this scale, the primary risk is not default, but the inability to refinance that debt when it matures. For the UK, the sheer size of the short-term war obligations, especially the sterling balances, meant that confidence was everything. If the holders of those balances, India, Egypt, Australia, etc., were suddenly allowed unrestricted access to convert those pounds into hard currency, specifically US dollars or gold, the UK's meager reserves would evaporate in days. To prevent this, the government maintained a stringent regime of capital controls and exchange restrictions known collectively as the sterling area or the sterling bloc. This was not merely an administrative policy, it was the life support of the remaining financial empire. It legally trapped liquidity. It forced global trade partners to utilize sterling, maintaining an artificial demand for the currency, masking the fundamental structural reality that the United States now commanded the global industrial and gold reserves. This constant need to roll over domestic and external debt, paying a non-trivial interest rate just to keep the IOUs outstanding, consumed a vast percentage of the UK's annual revenue. This dynamic creates a structural vulnerability that transcends history. Every time a major economy must dedicate an increasing share of its GDP to servicing rather than eliminating debt, that interest payment diverts capital from productive uses. The cost of servicing this historical debt, the high interest necessary to keep the market convinced the rollover is viable, does not remain sequestered in the Treasury. It ripples outward, distorting the cost of capital for every entity in the economy. This is how the macro becomes micro. When the central government is paying premium interest rates to service its sovereign debt, the cost of financing infrastructure, from municipal bonds funding hospital construction to the underlying rate setting the floor for commercial lending, is permanently elevated. This translates directly to higher operational costs for every business, higher rental costs due to increased mortgage rates on commercial properties, and constrained public services because debt service crowds out discretionary spending. This mechanism, the continuous drain of rolling over structurally excessive debt, forces a permanent structural trade-off in public welfare for fiscal survival. Guarde isso. É aqui que a maioria erra. They confuse mere financial stress with structural subordination. The strategy post-1945 was divided into clear phases. Phase 1 was the immediate post-war appeal for survival funding, culminating in the critical 1946 Anglo-American Loan Agreement. This loan was massive, but it was not merely liquidity, it was a Trojan horse. Phase 2 involved the acceptance of the explicit covenant clauses attached to that loan. These covenants were the conversion trap. The most devastating requirement was that within 1 year of ratification, the pound sterling had to be made fully convertible for current account transactions. This sounds like an arcane financial detail, but it was the mechanism designed to dismantle the sterling area's protective financial walls. The US, having established the Bretton Woods system where the dollar was pegged to gold, needed two things: open access to global markets and the definitive erosion of competing monetary blocks. Forcing convertibility meant stripping the UK of its primary tool for sustaining artificial demand for the pound. It was the formal acceptance of a new definition of monetary discipline, one where the UK's financial decisions would henceforth be judged and punished by the open market, whose reserves were overwhelmingly concentrated in New York. The UK Treasury, operating under the delusion that its reserves, combined with the US loan, could withstand the immediate pressure, was structurally unprepared for this test. They underestimated the depth of latent distrust held by the sterling area nations, who were eager to convert their captive wartime savings into the universally accepted hard currency of the future, the US dollar. This underestimation was fatal. Phase 3 was the brief, disastrous implementation of convertibility in July 1947. The market reaction was immediate and brutal. The run on sterling was cataclysmic. In just 5 weeks, the UK reserves hemorrhaged billions of dollars, and the new US loan was rapidly depleted. The British Treasury, in a desperate and deeply humiliating act, was forced to unilaterally suspend convertibility just 5 weeks later, demonstrating publicly and irrevocably that the pound's strength was purely artificial. The structural imbalance could no longer be masked by wartime patriotism or imperial decree. This collapse was the definitive moment of submission. It proved that the UK could not and would not operate as an independent monetary power. The structural foundation of global confidence had permanently shifted. The suspension of convertibility solved the immediate liquidity crisis, preventing the final collapse. But the price for this retreat was the formal acknowledgement of structural subordination. The UK had to return, cup in hand, to Washington, accepting the terms necessary for continued support and the deferral of the remaining loan conditions. The eventual outcome, though spread over decades, was the acceleration of decolonization and the definitive transition of the UK from a primary global power to a junior partner within a US-led security and financial architecture. The option of truly independent geopolitical action, military adventures, trade alliances, domestic fiscal policy, became constrained by the shadow leverage held by its primary creditor. This transition cemented the UK's role as a secondary financial state, capable of projecting influence only insofar as it aligned with the dominant economic structure. We are setting the stage for the crucial structural shifts that follow. Phase 4, which we will dissect in future intelligence briefings, reveals how this financial compromise translated directly into institutional and geopolitical alignment that persists to this day, locking in a specific trajectory of diminished sovereignty. The liquidity trap was sprung, but the wealth did not simply vanish into thin air, it migrated. The reserves flowed, the assets consolidated, and the influence was transferred. The question which defines the current macro landscape remains: the wealth didn't disappear, it changed hands. And who is holding it now? Until this point, we have analyzed the structural destruction inherent in sudden, forced sovereign restructuring, the visible cost of securing immediate solvency, marked by the irrevocable sacrifice of geopolitical agency and the permanent constriction of independent monetary policy. Now comes the uncomfortable yet essential sequel to that story, the phenomenon known in private capital circles simply as dry powder. This is the mechanism by which the structural damage outlined in the prior segment is converted into extraordinary, concentrated private profit. The wealth did not evaporate. It simply exited the immediate risk zone, parked itself in specialized hyperliquid vehicles, and waited patiently for the inevitable distress sales mandated by the new regime of high rates and structural financial discipline. Dry powder is not merely cash sitting in a bank account. It represents hundreds of billions, potentially trillions, of dollars of highly sophisticated institutional capital, pension funds, sovereign wealth funds, the largest private equity firms, and specialized distressed debt funds that raised capital specifically for the purpose of capitalizing on systemic stress. These funds operate on long horizons, typically 8 to 12 years, and are structured with ironclad legal covenants that compel their deployment during periods when traditional banking and risk capital are retreating. When interest rates spiked globally, destroying asset valuations across various sectors, from commercial real estate to municipal bond portfolios and leveraged corporate debt, this dry powder was activated. It is the designated cleanup crew, the mechanism for the great systemic reequitization, and the ultimate beneficiary of the structural crises that central banks intentionally precipitate to cool economic overheating. The core technique driving the deployment of this capital is the exploitation of the liquidity mismatch. When an entity, whether it is a highly leveraged corporation or a sovereign nation facing immediate reserve depletion, as the UK experienced in 1947, is forced to sell assets, they are selling into a market where buyers are scarce and time is critical. The price discovery mechanism breaks down, resulting in substantial discounts, often 40, 50, or even 60 cents on the dollar. The dry powder funds, being non-leveraged and under no immediate obligation to sell, step in as the buyer of last resort, dictating the terms and extracting deeply favorable covenants that ensure substantial future returns. They are not buying performance. They are buying certainty of future cash flow at a deeply reduced cost basis, secured by regulatory necessity. This is the difference between purchasing debt at par in a stable market and acquiring distressed debt packages that transfer ownership rights and operational control upon mandatory restructuring. The immediate benefit to the system is stabilization. The long-term cost is the permanent transfer of future equity and governance away from the public ledger. The historical echo is undeniable. When the UK accepted the terms of its post-war loans, it essentially agreed to a fire sale of its financial autonomy. Today, the fire sales are happening across balance sheets globally, driven by the unsustainable cost of rolling over low-rate debt in a high-rate environment. We are observing the mandatory deleveraging of the previous decade's exuberance. For the private credit desks, this is Christmas. They are not waiting for bank regulators to act. They are structuring bespoke deals targeting the fallen angels, previously investment-grade assets that have dipped into junk status purely because their immediate financing structure has become mathematically untenable. The funds provide rescue financing, but the price is equity, highly punitive interest rates, and often board control. This stabilizes the institution in the short run, but the entirety of the upside, the future growth potential, is now captured by the specialized capital holding the dry powder. Guarde isso, é aqui que a maioria erra. The true genius, or the ultimate brutality, of this phase is the socialization of the pre-loss. Before the dry powder is deployed for profit, the initial damage is absorbed by the public sector and the retail investor base. The high interest rates required to fight inflation slow the economy, reduce tax receipts, increase government debt servicing costs, which are ultimately funded by the taxpayer, and deflate the value of assets held by standard public vehicles, like pension funds invested in traditional fixed income or equity markets. The general public bears the pain of the correction: higher unemployment, increased cost of living, reduced public services, all stemming from the necessity to establish the conditions for future financial stability. The central bank, acting as the ultimate authority, creates the necessity for correction, and the sovereign balance sheet absorbs the debt. However, the profitable restructuring of those distressed assets, the eventual equity upside derived from the cleanup, is privatized. The structural loss is absorbed by the sovereign and the citizenry, but the subsequent gain is transferred to the highly concentrated pools of patient capital. Consider the practical implications through our macro anchors. The macro decision, the sustained high-rate environment engineered to flush out bad actors, and excessive leverage, translates directly to municipal and regional governments failing to refinance critical infrastructure projects. When a necessary municipal hospital or a regional energy grid faces a bond maturity wall, it cannot breach at current rates. The dry powder funds offer a solution. They step in, buy the underlying debt or assets at a substantial discount, and then restructure the operational model, often introducing or dramatically increasing user fees, tolls, utility rates, facility charges, to guarantee the requisite high returns on their discounted investment. The public receives the continued service, avoiding immediate collapse, but at the permanent structural cost of higher prices and the transfer of long-term control over essential assets to a private, globally managed entity. This ensures that even once inflation is beaten and rates eventually decline, the cost structure for the end user remains permanently elevated, locking in the profitability for the capital that deployed during the distress period. The conversion trap is sprung when the choice becomes not if you will sell, but to whom you must sell to survive the quarter. This is the definition of structural subordination accelerated by fiscal necessity. The British Compromise in the 1940s established a template. Immediate financial stability is achievable only through a trade-off in long-term control. Today, that control is not being handed over through a treaty signed in Washington. It is transferred through the silent, precise execution of legal covenants in high-yield debt restructuring agreements. The consequence is the same. The capacity for truly independent strategic action, whether military, commercial, or fiscal, is diminished, because the underlying financial infrastructure is now subject to the expectations and profit mandates of external capital providers. The nation or corporation becomes a secondary financial state, solvent but strictly disciplined by the terms of its survival. This ongoing structural transfer answers the fundamental question left hanging at the close of our last segment. The wealth that fled did not disappear, it repositioned, and it is now deploying with clinical precision, capitalizing on the high rates that initially caused the widespread damage. The cycle is complete. The central bank imposes discipline through rates, creating distress. The sovereign absorbs the initial loss, and the patient institutional capital reaps the long-term equity rewards. This mechanism ensures that the next cycle of global growth is financed and largely owned by those who held the liquidity and patience during the crisis. The ultimate legacy of any systemic financial crisis is not the destruction of capital, but the forced, accelerated redistribution of ownership and future cash flows. The cost of institutional survival is always paid through the permanent, structural diminishment of sovereign autonomy and the quiet socialization of ongoing liabilities. The covenant for solvency is always sealed with equity. We have explored the historical parallel of structural sacrifice in the face of financial necessity and detailed the contemporary mechanism, dry powder, that converts sovereign and corporate distress into concentrated private profit, resulting in the socialization of pre-loss. The question that remains is starkly numerical, rooted in the aggressive interest rate maneuvers of history. If interest rates at 20% fundamentally broke and restructured developing countries globally in the 1980s, the so-called Volcker shock, what happens when the same structural pressures and debt loads are applied not just to the periphery, but to the core financially leveraged economies of the modern world? The price of immediate solvency is structural servitude. But there is one final, often underestimated weapon in the arsenal of imperial fiscal engineering, a tool that transcends mere interest rate policy and debt restructuring: the strategic application of taxation. Join us next time on Macro Threshold as we dissect taxation as a Roman weapon, the fiscal engineering behind imperial order, and reveal how the most enduring empires controlled commerce, secured loyalty, and financed endless wars without relying exclusively on the volatile mechanisms of monetary policy.